Can the Federal Reserve actually begin to tighten their asset purchases and eventually stop purchasing assets altogether? And can they actually aggressively hike rates this year? This is a key question the market is struggling with right now. And I think that the stock markets and more importantly the credit markets are providing the answers right now to that question. And ultimately, I don't actually think the Fed really has a choice in terms of tightening on an economy that is already beginning to show great signs of weaknesses right now. With regards to the CPI inflation report that came out today at a 40-year high of 7.5% year over year, and also looking at other ominous signs in the market, such as the bond markets with rates reacting very aggressively to this 40-year high print on CPI. I don't think the Fed actually really has the leniency that the market is pricing in right now. So in a lot of ways, I am more skeptical in terms of the mainstream narrative right now being that the Fed will raise rates anywhere from 4 to 5 or up to 7 times this coming year. And also with regards to their asset purchases, I actually don't think that they can be as aggressive in terms of toning down their asset purchases and eventually tightening, so selling off their assets. I actually don't think that that's really an option for the Fed at this point, simply because they first of all want to maintain the solvency of the credit market. That is their first and foremost priority. If they lose the credit market, if the credit market becomes illiquid, so credit market, basically think of debt. Think of the bond market. This is by far the largest market worldwide, about 3 times the size of the stock market, so it's extremely important. And in this current economy we're in, where the economy is just so leveraged in debt right now, the credit market is extremely important to keep solvent. Without the credit market, basically the entire system would collapse, because if you are unable to service the already existing debt by issuing more debt, if you're unable to keep that system going, it will inevitably collapse. And so I don't think the Fed actually has a choice in terms of tapering their asset purchases and raising rates as aggressively as the market is pricing in. We can look at the Fed Reserve balance sheet, and they announced just last November that they would begin tapering their asset purchases by 15 billion, 10 billion less in treasuries and 5 billion less in mortgage-backed securities. And then let's go and look at their balance sheet that's available out there. And at least, up until just a couple weeks ago, so the end of January, it doesn't really look like they've been actually tapering their purchases in line with this guidance they gave. We can zoom out, look at the 6-month chart of that, and it basically looks like the exact same trend has been continuing. So there's some questionable activity, looking at the Fed's actual asset purchases versus what they've said would be their asset purchases. But clearly they are not aggressively tapering right now, and I don't think that they will have the option of tapering going forward, simply put, with how large the sell-offs of these massive companies out there have been. Look at Facebook setting the record for the largest single-day loss in a company of 232 billion, somewhere around there, I think. In a single trading day, they lost almost $250 billion in market cap after losing users for the first time in their company's history. Same story with Peloton, same story with Spotify and PayPal and Netflix. So all of these large companies have had massive sell-offs. And it's not just to the downside. Obviously, Amazon, I think the world's second largest company, are very, very close to that. Amazon, as well as Snapchat, had massive rallies after reporting better than expected earnings. So it's mainly to the downside that companies are experiencing this volatility, and but it's also to the upside that these extremely large companies are experiencing volatility. Now, why could this be? Why are these massive companies trading like penny stocks? It's really not heard of for this to be happening, and this really has to do with liquidity being at very close to the lows that were seen back in March of 2020. They're at the lowest point they've been since then. So basically, found a very helpful article out there on Financial Times. It basically explains how liquidity is very low in the stock market right now. and how this is also causing these massively volatile swings in these massively large companies. So let's look at this. Ricky Fishman, a Goldman Sachs strategist, noted that liquidity had weakened so substantially that the difference between the prices at which traders can buy and sell S&P 500 index futures, one of the most popular tools for betting on the direction of the U.S. stock market, was frequently reaching 50 cents over the past 2 weeks. That is double the standard 25-cent gap registered in a healthy market. Weak liquidity leaves the potential for outsized market moves, he said. These swings have been on display as some of the largest companies in the U.S. reported results, with those falling short of Wall Street estimates plunging in value in magnitudes rarely seen outside of a crisis. And that is correct. I mean, since March of 2020, since that whole sell-off, we have not seen moves like this in companies, to the downside mainly, but also to the upside. And that really has to do with just how low liquidity is out there right now. We can look at this chart basically showing how liquidity has dried up in the U.S. stock market to an extent that we have not seen since, the March, April of 2020, since right after that sell-off during the initial COVID shock and shutdown and everything. Liquidity has essentially been on a downtrend since, August, September of 2021. And the Fed announcing that they would reduce asset purchases and, eventually be net sellers of assets, I don't see that as a possibility for them right now. Simply put, they don't really have the option of beginning to not be as big of a player in the credit market as they have been in the past, especially looking at with how skeptical other institutional investors and large players in the market are right now. I just don't think the Fed really has the option to step out of the market in a meaningful way. Now, the market narrative right now is that the Fed will, in fact, go through with their tightening of asset purchases, with their taper, and also with their rate hikes in the coming year. And, that's the current market narrative out there right now. And so, it makes sense for stocks to be correcting, for the S&P, the NASDAQ, and, all the major indices to be actually correcting in a sizable way. It makes sense for that to be happening right now, if in fact the market believes that the Fed will do this. However, if the Fed does backtrack, if they don't raise rates in March, if they backtrack on their taper guidance, I do think the market could actually react to that in a positive manner. However, I do think the main beneficiary of that move, the Fed might announce, or if they even announce it, maybe it just becomes more of a implied move that the Fed really doesn't have a choice. I have seen some headlines out there that are kind of more leaning towards that move in the narrative, and if the narrative moves in that direction, I do think the main beneficiary would be gold and silver, which is really where for the last year I've expected that people would eventually get on board with gold and silver and just looking for protections against just extremely negative real interest rates. Right now we have inflation, CPI and PPI at 40-year highs, and yet we have bond yields that are way below that. We have real yields that are arguably have never been lower than where they are right now. So I do think that the main beneficiaries of this kind of a shift in the narrative and shift in possible Federal Reserve guidance, I do think that would benefit gold and silver and the miners the most. But it could also benefit growth stocks as well. Just looking at growth stocks, they're particularly affected whenever there is spiking yields on bond yields. So it makes sense why growth is really being hurt right now with treasury yields spiking. However, if that narrative begins to shift, I would actually expect growth to begin to outperform value in that kind of an environment, even though a lot of these companies really don't have good fundamentals behind them. I just think in the short term, the market could get behind growth again, and you could potentially see Cathie Wood's kind of ARK investment fund get pushed into the spotlight again. She's really been underperforming the rest of the market for the last year, but even though I do strongly disagree with her picking of these companies, I don't think they're actually good value stocks or whatever the narrative she's putting behind them is, but I actually do think the market could temporarily turn in her favor in that kind of an environment. But ultimately, we will have to see, what the narrative is out there in the market. I just looking at the key factors I've just pointed out with regards to volatility spiking, and also with regards to liquidity being extremely low. I just don't think the Federal Reserve has the option to raise rates and, more importantly, to taper at this point. I just think they'll basically have to go along with reversing course, and I do think that that would prove very beneficial to gold and silver miners and gold and silver as commodities, and also a lot of other commodities and growth, surprisingly. So all that being said, I'm curious to hear what you guys think about this content I'm putting out there. Leave your comments down below. If you want to hear more, just consider subscribing to this channel, and I hope to see you again at some point.